Cramer. Welcome to Mad Money. Welcome to Cramer, my friends. Hey, look, I'm just trying to make you a little bit of money here. My job is not just to entertain, but to put it in context. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Performance is not in the eye of the beholder. And it's pretty easy to see that some formerly unstoppable stocks have momentarily lost some of their mojo. So on a day where the Dow soared 646 points, S&P advanced 0.21%, but the NASDAQ, where much of tech dwells, declined 0.26%, let's take a hard look at what should be done with beloved stocks that have been stalled. Stocks like Apple, Meta, and Tesla, all of which are up about 10% for the year. Let's start with what the heck is happening with the actual stock market. Today, for example, was a very logical day. Yesterday, the Fed cuts rates. Today, money managers rotated into stocks that will benefit from rate cuts. Makes sense, right? Rational. Even if they had to sell other things to raise money. Things like tech. Sell, sell, sell. First, lower rates spur consumer spending. So naturally, the conspicuous consumer stocks are up nicely, starting with the totally discretionary cruise lines. Does that mean more people necessarily called Norwegian Cruise today to book a cruise? No. But if they were thinking of booking a cruise on credit, that just got cheaper. And a lot of what happens with stocks is theoretically based. Hard for you at home, trust me. Second, lower rates spur home building and home buying, and they spur home improvement, which can be financed by a home equity loan. There's a second-day business after a rate cut, so predictably Home Depot was really on the move again, even as I'm sure nothing extraordinary is going to happen there with a quarter-point cut. Still, we own it for the charitable trust. I'm going to talk about it in tomorrow's club meeting, but long story short, I think the despot works here. Even if ICE, the immigration police, keep prowling their parking lots looking for people to deport, and that has hurt the stock. I know Home Depot's been doing poorly. Okay, I totally get that. What matters is management just told us that they'd do better if rates came down, and then rates came down. Don't outthink it. Trust them. I do. More broadly, retailers work when the Fed cuts. Always have, always will. Here I'm thinking of companies like TJX, which underperformed today, Walmart, even Target, which could roar if it can demonstrate any sort of turnaround. Depot kills two birds with one stone. The dollar stores, if they have good numbers, will get higher price earnings multiples. Those are really flying. Industrials always work in response to a rate cut because every hedge fund has been schooled to believe that these stocks go higher when the economy improves. We saw that yesterday with many of the industrials. And again today, second day. What I saw go up, I saw 3M go up, DuPont and Dover. The latter two in the charitable trust, which you can follow along by joining the CNBC Investing Club and get in on tomorrow's strategy session / club meeting. These kinds of stocks can all work for a couple more days. They have the wind at their back now. I love the transports, which are clearly breaking out here. I mentioned J.B. Hunt yesterday. It just started. It's going higher. Transports tend to run at least 5 days after a Fed rate cut. Not too late here. I, by the way, reiterate that this could be the breakout quarter for Federal Express, FedEx. Not too late for the companies that make aircraft or aircraft parts either. Check them out. For ages, banks have been valued on their net interest income, meaning how much they make on the difference between what they pay for your deposits and what they charge you for your loans. Now you have to switch direction and think which banks will lend more, as there's going to be plenty of demand. And that's a much better way to own a bank stock. That's why I like Wells Fargo, now that its asset cap has been lifted, and Capital One, because it bought Discover and is about to rival the big other credit card companies. They're up on a spike, both of them. Maybe you got to wait a bit, but I got to tell you something. You want to own them now, especially, I'll tell you, if JP Morgan were back where it was the other day. Remember I said to buy the stock because they had that meeting and sent the stock down? The stock went down to 300. It's at 317. I mean, enough already. Finally, because we have a president who thinks that rates are still way too high, and he'll appoint Jay Powell's replacement, who takes over next May, we don't even need to play the guessing game about how many more cuts we're going to get, although people constantly do it, and it does drive me crazy because it makes money. I say go to Kalshi. What matters is that the lower rates go, the more people will seek income from higher yielding stocks because the bond market just won't be as competitive. I spend a great deal of time on how to make money in any market discussing these kinds of stocks. But the best ones right now are the nat gas pipeline operators. They're all in the book, almost all of which have higher yielding. They're much higher yielding than treasuries. Now let's get back to those three formerly magnificent stocks that only rallied about 10% this year, Apple, Meta, and Tesla. Apple's not really impacted by lower rates. It has an immense cash position. It'll probably earn less on its cash. It's considered an AI loser, even though I think their installed base of over 2.3 billion devices and 1.5 billion users means one of these big chatbots will pay them a fortune to be the default platform, just like Google did with search. The long knives are always out for Apple, but if we all think that the hyperscalers are spending too much money on data centers, a continual big theme today about Oracle, then how the heck can we chide Apple for not doing much at all of spending on data centers? If OpenAI were to pay Apple $25 billion a year to be its default AI choice, it might be the greatest free rider case in history. If Gemini were to do it today, with today's Alphabet stock already red hot, that would go up another 50 points. All that said, Apple simply is not a beneficiary of lower rates. And when you're within a day of a rate cut, it's not the kind of stock money managers have any interest in. Apple's a momentary yawner and an underperformer as people sell Apple to move into these industrials and these banks, the other stocks I talk about, like maybe the retailers. That's just what's happened. It's happened no matter what. There's no way to relate Meta to rates either. It simply doesn't matter to the company. The stock is listless because it's become a one-day story the day it reports. I could argue that a Fed cut actually hurts Meta because it calls attention away from what might be happening at the company, which is very quiet but very good. I think the world of this company, and we hear that they're raising prices for their AI products. They should. They're too cheap, but it doesn't matter unless Mark Zuckerberg comes on to tell the story right here. Finally, Tesla's transitioning from auto company to tech company, from a company that's getting its head handed to it in sales to a company that's a nascent leader in robots and self-driving cars and in energy storage. The auto business benefits from a rate cut, but Tesla no longer trades like an auto stock. Everything else is totally unrelated to the Fed. It doesn't work. No wind at the back of any of these. Worse, when you get bad news from a big company like today, a tech company like Oracle, Oracle obviously seems to be promising more data center construction than its balance sheet can handle. If fewer data centers are built, that's bad for NVIDIA and the entire cohort. There's nothing from the Fed that helps any of these stories. And right now, money managers only want rate cut beneficiaries and nothing else. So everything trades down in tech. Well, listen to me. I wish that there were more to it than this. I wish I could tell you that there was something good happening with the winners or something bad happening with the losers, but it isn't. It just happens to be the stock market. Bottom line, you're ultimately just looking at fund flows. The more trading-oriented hedge funds are doing what I just described. How do I know this? I plead guilty. I was one for 14 years, and I did this exactly. Periodically, though, you know what I did? I get fed up with what everyone was doing, and I try to deviate, drifting from the hedge fund playbook. The bottom line, you know what happened? I got pancaked pretty much every time. It doesn't work when you freelance, when you want to be a pirate, when you want to listen to the beat of a different drummer. Hedge funds are like pack animals. When they move at once, like they did today, it's very costly to try to go against them and buy a lot of tech. I know. I have the tire tracks on my back to prove it. Robert in New York. Robert.
Jim, how are you? And I want to wish you a Merry Christmas, Happy Holidays to you and Lisa and the gang. You've done phenomenal things for us this year.
Oh, thank you, Robert. Thank you so much.
She better buy you a good gift, Jim. That's all I can say.
I don't know. Well, let's see. Let's hope she does. That's all I can say. Thank you.
Well, Jim, let me tell you something. You've made me so much money in a stock we're not talking about tonight, Caterpillar. You crushed it for me, and I want to thank you on that.
Thank you.
$300 a share. April 5th was when you were on the show, and you said, don't sell the stock at $238. And I want to
But remember, that was because Jim Elpelby was the CEO back then. We had just gone to a Cowboys game together. He wasn't really a Cowboy fan, just so you know, but he did the right thing. And I just felt like, you know what, this guy, he doesn't talk about the stock. He just talks about how he was so excited about all the things at the company, and boom. It was a great thing. It was a great thing.
Thank you for doing it for me, Jim.
All right, what's up next? Let's do some more.
Yep. This next company reported fourth quarter results of 4.63% versus the 4.38 consensus estimate. Now, this earnings beat represented a 5.8% surprise, making this the sixth consecutive quarter that exceeded analysts' expectations, Jimbo. And analysts remain moderately bullish on this, and so do I, because you've got a great management team, Doug Yearley, Toll Brothers.
Oh, you're so right. Look, that's exactly what you buy here. I think Toll is doing phenomenally. The only thing that was bad was that he said, look, if rates don't come down, we're not going to have good numbers. Well, guess what? Rates are coming down. I totally agree with Robert. Great call. Let's go to Sam in Pennsylvania. Sam.
Jim, I got an interesting one for you. You know, looking at the Kalshi spread, it looks like the market is pricing in a 75% chance that the tariffs get struck down. So I'm looking at Old Dominion, and I'm looking at their less than truckload freight business, and I think that this could be an interesting stock to play. The potential for tariffs coming down and their freight volumes increasing, especially.
I agree with you. I agree with you. I do now. Just I like Old Dominion. I really, really, really like JB Hunt, but my favorite is Federal Express, FedEx. Darn. Look, it's hard to go against the grain with a move like we had today. And sometimes the best thing to do is just follow where the money is flowing. And that's what I'm telling you is happening. On Mad Money Tonight, is it time to call a comeback for the consumer? I'm taking a look at the stocks tied to the travel industry to see if the recent moves higher have staying power in this market. Then for investors looking for a pure play in the ice cream space, look no further than this new company, Magnum Ice Cream. Started trading earlier this weekend. No one's paying any attention. I'm going to give you the inside scoop to see if this company should be on your buy list. And shares of lumber producer Weyerhaeuser have been on the chopping block this year. Today's investor day was really good, but it can be the catalyst to turn around the stock. I'm finding out more from the CEO, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.